Hello and welcome to this video. In this video we're going to talk about a topic that's really important if you're a small business owner. You see, as a small business owner, one of the considerations you'll be asked to make is, do you go as a sole trader or do you go as a limited company? And talk to any accountant or any business advisor, majority of the time we would advise a limited company as the most tax efficient way of running your business. Now, if you've opted to go down a limited company or considering it, then the one major thing that you need to consider, or at least be disciplined on, is the concept of your director's loan account. And that's what this video is all about. Today, we're going to have a deep dive into what director's loan account means and how that can affect you and your business. This is definitely one not to miss. Stay tuned. Hello, my name is Aaron Patrick. I'm a chartered accountant, a certified UK trainer with a fancy new logo, that QuickBooks Chap on the internet, and also head of accounts here at Boffix. Now, today's video is all about director's loan account. Now, the director's loan account is going to be something really essential if your business is operating as a limited company. Maintaining and keeping a director's loan account can be the difference between you having a really healthy and efficient tax position or you're actually into some really nasty taxes that are easily avoidable. So let's start first of all and think about the concept of what a director's loan account is. To help me further, I'm going to draw out on here some scenarios for you so we can try and picture what a director's loan account is. So first of all, the most important concept to remember is if you have a limited company, then your limited company is separate to you. And there's actually a line between you and your two separate entities. And that concept that your limited company isn't you, which is different to as a sole trader, because as a sole trader, your business is effectively you trading as yourself. But as a limited company, this limited company on this left-hand side is separate. Now, from a tax point of view, this limited company will go about and it will make profit. It will sell items and it will create itself some income. It will then create some expenses. It will make profit. And it will pay taxes on that profit. Really straightforward. And that limited company will just keep going and going and going. It has its own tax years. It has its own requirements of when it needs to file returns and making sure everything's completed. And we've covered a lot of that on past videos. So make sure you like and subscribe, and also stay in touch for future videos when we're going to be going into that into a lot more detail. But that aside, that's the business. Today, what we're talking about is how you, the person who's actually running that business, interacts with that limited company. Because I assume, and tell me in the comments below if I'm wrong here, but you're not running that business just so that you can let that company make profits for itself and just keeps churning and churning and churning away. I assume, just like everyone else in business, that you also want to be remunerated for all that hard work and for those profits that have been generated in that limited company. You want to get remunerated for the work that you've done for that business. So if that's the case, that's where the director's loan account becomes a crucial part of how you're going to become remunerated. You see, in past videos, and again in future videos coming up, we talk a lot about the best way to be remunerated as a director of a limited company. If you're running a limited company, we've gone through in depth into why having a salary plus dividend is going to be the most tax efficient way. The idea that you have a really low salary, what we would class as what's called a director salary, and then you would top that director salary up with dividends, and if done correctly, can be by far the most tax efficient way of getting money out of a limited company. So let's kind of draw that out. So we now need to concentrate on this person on the right hand side, you. We want to make sure this person is really, really happy. To be able to be happy, they're going to have to, or they're going to want to take money out of that limited company. So we're going to have to find a way where we can bring money from the limited company into you personally. Now again, the most tax efficient way is that you take a small salary plus dividends. And if you take that in the most efficient way, and you take that small salary and you top it up with dividends, then again, you'll have a really tax efficient way of being able to deal with your taxes. The problem is that salary plus dividends, having it in that way, you're going to have to be extremely disciplined for you to be able to survive on that metric. Because ultimately what that means is that salary you could probably do monthly. So in this scenario, maybe each and every month you're getting £750 salary, but then on a quarterly basis, you're getting £2,000 of dividends. And let's say in this scenario, that's more than enough for you to survive on, and that's what you're looking to budget against, especially at the beginning when you're trying to build that business up and you don't want to take too much money out of the business itself. The problem is that is £750 per month, so that's subject to the business having that cash available to it each and every month. And then the dividends, again, subject to the dividend cash being available for the business, and also meaning that you personally have to budget that every quarter you're getting basically a bonus coming through. Now, even with these small numbers, that could be difficult for you to budget against, because it could be a case that by the time you've spent your mortgage and everything else that goes with it, that's £1,000 that's been taken out of just general expenses. Well, you're only getting £750 per month, so it doesn't give you much room to play around with. Now, if you have that £2,000 dividend on top of it, you might be comfortable at that point. But you've got to remember that that's only coming in quarterly, and really from a dividend point of view, you want to keep that quarterly to make sure that you're proving to HMRC that it is a true dividend and you're not trying to mask some form of additional salary. So we always recommend that your dividend is taken on a quarterly basis. Now, if you were budgeting like that to the penny, there's other considerations you need to make sure. You need to make sure your limited company is producing a profit of enough that down here, that once the tax has been paid for on a quarterly basis, that you had enough to pay that £2,000 dividend. Otherwise, you're paying yourself what's classed as an illegal dividend because you didn't have the profits to claim for it. From a cash flow point of view, you've got to make sure that there's enough cash in the limited company, each of those steps, so you can take your monthly salary and you can take your quarterly dividend. And ultimately, it's going to give you a bit more of a headache in terms of the administration. That's where the director's loan comes into play, and that's where you should hopefully be able to understand where the benefit of the director's loan is. You see, let's take the same scenario, but part of the limited company, we're now going to have our director's loan account. Because the easiest way to think about what a director's loan account is going to be the idea that it's a part of your limited company and it's almost like another bank account within your limited company. And it's actually your bank account, it's your money. And the director's loan account can be interacted with multiple ways. So in this scenario, what we could do is instead of paying your salary directly to you, you pay it into the director's loan account. So in this case, it was £750 per month. And then every time you pay a dividend, you pay that into your director's loan account, £2,000 per quarter, for example. And what that means is your director's loan account is slowly growing. And for you personally, let's say you need £1,000 to live on, then you will take £1,000 each and every month out of the director's loan account into you. And that means that you've got a residual balance within that director's loan account, which in this case is growing at a healthy rate. And the most important concept of you taking that £1,000 out is that any taxes that are due from those payroll or that dividends has already been accounted for. You've already accounted for those taxes in their various ways. So you taking that £1,000 out of money that's already associated and allocated against you mean there's no tax consequences whatsoever. So it simplifies your tax, because from a tax point of view, it doesn't matter if you take £1,000, £500, £200 out at that point. From a personal point of view, it just means how much salary you took in the year and how many dividends you took in the year as well. Simplifying your whole tax system completely. Now, the director's loan account isn't just for looking at your salary and your dividends coming in. There's another crucial bit to it as well, and that's basically every time you interact with your business. So, for example, what if you had a laptop and a chair and a computer desk, and you had all of these assets that you know your business needs to be able to continue to work, and you already bought them before you started working with them? Well, you will have the opportunity to basically sell those items to the limited company. But at the very beginning, the limited company may not have enough cash to be able to buy these assets at their market value. So traditionally what we would do here is we'd see what the second-hand value of these assets were to introduce them into our limited company. But instead of going directly into the limited company and then having to pay cash over straight away, which again, you may not have enough cash to do that, instead of doing it that way, why not introduce it to your director's loan account, creating a balance against you that you can then withdraw at a later date when you feel that you have enough cash to be able to make that payment. And the way that works is that you are introducing the asset into the limited company, but crucially, you're not having to take that money now, you're taking it at a later date. When you do take that money, again, no tax consequence whatsoever, because it will be money that's already owed to you and you're just taking that money that's owed. So that's the concept of it. The concept is that you have a director's loan account within a business and you can utilise and draw against that director's loan account when you need to. Now, there is one big caveat to everything I've just said there. And in all of those scenarios we talked about now, we're always in a position where the director's loan account owes you. So the company owes you some money. Now, again, it could be salary you've not taken, dividends you've not taken. It could be the fact that you've gone and spent something outside of the business. So imagine you took the wrong card and you went to pay for something and you paid personally. Will that be a director's loan transaction as well? But any of those different scenarios, that's all about you accumulating balance within the business, ready for you personally to be able to take that money out and basically recoup expenses, recoup costs that was owed to you as a director. When we're in that scenario and it's the money is owed to you, no problems whatsoever. Again, if there was any tax consequences, that's already been dealt with and that would have been dealt with separately. So if you did have salary or you did have dividends and you just chose not to take the money there and then you would actually be able to see that from a tax point of view, they will be accounted for at those points. The key is when you take money out that way, the tax consequences of it have already been considered. The key problem we have here is if we're the other way around. You see, if the scenario was that it wasn't that the company owed you, but you'd taken too much out of that director's loan account, and it becomes a term we like to call an overdrawn director's loan account, then we do have some tax consequences we need to consider. And that's what we're going to talk about now. Okay, so let's look at these two scenarios here. On the left-hand side, I've got a director's loan account where we're owed £1,000. So that means we can take £1,000 out of the company and have no tax consequences whatsoever. On the right-hand side, though, is a director's loan account where we owe £1,000. That means that if we take another £1,000 out, we're going to actually owe £2,000 at that point, and we need to be able to ensure that we can try and get that back into the green in this case. You see, from HMRC's point of view, remember what I said about this balance over here. All of your taxes have already been accounted for. If that was a collection of salary, dividends, or whatever it's going to be, then you've already going to account for those taxes in one way or another, for your self-assessment or through your payroll, however that's going to be dealt with. But in the scenario on the right-hand side, where actually at this point you owe the company, that means that your taxes haven't been associated or been dealt with. That means that you've not declared enough dividends, you've not declared enough salary. Whatever the reason is, there's not enough in there to be able to account or to be shown from a tax point of view. And the scenario that this normally comes into is when you thought that you had more profits than you did, and you've tried to draw out dividends and you've not actually had enough dividends to draw against. You had every intention at the end of the year to withdraw 20,000 dividends, but it actually turns out you had 19,000. Therefore, you can't account for that extra £1,000. That's why in this scenario, we're £1,000 short. From a HMRC point of view, as you can see, they're really happy with this scenario because your taxes have been dealt with. In this scenario, though, they're not happy because, again, you've either had to underdeclare what dividends or salary you've had, and therefore you haven't paid the taxes to be able to take that money out of the business. And that's a concept we really need to get our head around. In that limited company versus sole trader income Soon as you take money from the limited company to you personally, you should be able to declare that as some form of taxes. So what happens when you have an overdrawn direct loan account? Well, first of all, the amount of overdrawn direct loan account is really important. One of the key things to remember is if your director's loan account is more than £10,000 overdrawn, then straight away the tax that needs to be charged on that is a tax called a P11D, and it's all to do with a benefit in kind. Now, effectively, what HMRC are saying here is you've taken this as a loan, and unless you've charged interest on that loan, then HMRC would insist that you charge interest at their rates. So that if you are treating this as a full-blown loan and you've taken this money out and you have every intention to pay it back, but in this case you haven't paid the loan back yet or paid any interest, should I say, on the loan, then at this point HMRC, if it's over £10,000, would want you to include that as a benefit in kind. Now, you can either pay that difference and pay that interest over, maybe on a monthly basis, or something that will actually go down in terms of making sure that from a HMRC's point of view, it isn't an interest-free loan and it's subject to all their criteria, then that's fine, no P11D needed. But if you haven't got that loan documentation in place and you're not declaring that interest and you're not paying that interest over, then we have to declare that on a P11D. We have to create what's called a benefit in kind. And the idea then is you are receiving an interest-free loan and you are going to be taxed on the fact that you're receiving that benefit, that interest you haven't been paying over. So the interest that you should have paid over becomes a taxable benefit to you personally. And that goes on what's called a P11D, benefit in kind. So that's number one. The other one, and this one can be even more painful, is a term called Section 455. And the whole idea of this is from a corporation, so from a company point of view, they've given out this money interest-free, but what needs to be done is that we need to make sure that it's paid back 9 months and a day after the year end. And if you remember that 9 months and a day after the year end is also the same day that you need to be paying your actual taxes over to HMRC, corporation tax that is. Now, Section 455 basically only applies at the very end of your financial year. So if you had a financial year of the 31st of the 12th, 2021, then as at that financial year, if you had a overdrawn director's loan account of, say, £5,000 at that point, so we're still below that £10,000, we don't have to worry about P11D in this instance. But if you still have an overdrawn director's loan, then you have basically up until 9 months after that point. So you've got till the 30th of the 9th, 2022. Technically, you got 1 day as well, so 1st of the 10th. And then you've basically got to make sure that that loan there has been paid. If the loan has been paid at that point, then there's no additional tax charge. There's none of this Section 455 at that point. If the loan hasn't been paid, though, unfortunately, we have a Section 455 tax charge. Now, the tax has different rates applicable to it, and depending on what tax year in is there. But currently, the highest that can be is 32.5%. And that's 32.5% of the remaining loan. So in this case, £5,000 times 32.5%, £1,625 of additional taxes that's payable on that same day that the rest of your corporation. So 1st of the 10th, 2022. Now, the only saving grace to this tax is that if this loan is then paid back in a future year, then any taxes that you've actually incurred is repayable to the company. Problem being, you have to wait until your next actual financial period and your next CT600, because that's where this goes, is on your CT600, is put in. But at least you have the opportunity to get that tax back. You just may, from a cash flow point of view, have to be waiting a while for that to happen. So let's recap. First of all, a director's loan account in a limited company is actually a really useful tool to use as a director of a limited company. It means from a cash flow point of view, you don't need to worry about your business having enough cash to be able to pay salaries and dividends that's available to you. That means that you have an opportunity to build that director's loan account up so that in the future, you can take money out of your business without having to worry about the tax consequences about it. And if you've had to invest heavily in your business at the beginning, that's all going to go against that director's loan account and increase it going forward. So again, you get to draw against that at a later date with no tax consequences. So when run correctly, your director's loan account is going to be a really useful tool for you to be able to make sure that you actually have that all sorted. The downside though is, as we've just mentioned, there are really nasty tax consequences if you get this wrong. There's a potential for a P11D, which means that you have not been charging interest on your loan. And also, if it is overdrawn at a year end, then you only have until 9 months after that year end to make that payment good. Otherwise, you have a really nasty tax in form of Section 455. And that's it. Now, what did you think to that? Is that something that makes it more clear to you as to what a director's loan account is? If so, let us know below. Let us know how you run your director's loan account. And keep an eye out for a video over on the other channel, Aaron Patrick, the QuickBooks Chap. We're going to be talking about some actual practical tips of how you can keep on top of your director's loan account so that you don't come in that overdrawn position. And also we're going to show from a practical point of view how that balance occurs, what happens, what affects that actual director's loan account. So definitely not one to miss. Keep yourself subscribed to this channel though, because we're going to go in more detail about other elements that are going to affect you and your business. And head over to Aaron Patrick QuickBooks Chap for another subscribe over there to be able to get some more practical tips of how this can relate to QuickBooks Online. And furthermore, let us know, is a director's loan account the one thing that puts you off being a limited company? Is being a sole trader and having it much more simplistic better for you? Let us know. Let us know what works for you. Again, some massive tax savings if you do a limited company right compared to a sole trader. But as you can see, if you get it wrong, there's some real nasty taxes that can come along and be really painful for you as well. My name's been Aaron Patrick. As always, been an absolute pleasure to do this video for you. Can't wait to do the next one for you, and I'll see you in the next video. Bye for now.